Altcoin investments are very difficult because most altcoins tend to grow in supply, as in the early investors tend to cash out, the team tends to cash out over time. Also, there's more and more competition, there's more and more blockchains that launch, there's more and more protocols that launch. But Sui, interestingly enough, despite the rising inflation, despite the rising supply over time, tended to outperform Bitcoin and Ethereum. Now, in this video, we're going to look at the on-chain data. We're trying to figure out whether or not it still makes sense to get into Sui. Is currently the valuation still cheap enough? Does it make sense to allocate towards Sui versus Bitcoin and Ethereum? Let's have a look at the data most people are not considering. Now here's Sui's tokenomics over time. How many Sui tokens are actually circulating? And this is not necessarily the prettiest of all charts. The maximum supply is at 10 billion. Sui launched with a supply of only 500 million and grew in a bit over 2 years to 3.5 billion. Interestingly enough though, Sui was able to keep pace with Bitcoin, as in it trades in a range despite all of that additional supply hitting the market. And one could make the argument that relatively speaking, the Sui supply will grow much less in the future, which could help Sui to finally break out of this trading range. If we stay within the range, then there's an upside of roughly 60%, but also risk of 60%. Now, the total value locked, or the capital that's currently on the Sui chain, tends to rise over time. The blockchain started out with around 10 to 20 million of TVL and grew all the way to above $2 billion. A lot of the recent growth is due to Bluefin. Bluefin is a decentralized perpetual futures exchange, very similar to what we have with Hyperliquid with its own chain that's also got a bridge from Arbitrum. But perpetual futures is not the only reason why Sui is getting used. Here is the decentralized exchange spot trading volume on Sui over time. This is now measured in Sui, not measured in US dollars. So we can clearly see how the blockchain is getting used more and more over time. So this is not just the Sui price going up, this is also measured in Sui, more and more transactions happening. At the same time, the app revenue is relatively constant. When we look at the TVL, not in US dollars, but in Sui though, the growth isn't necessarily as constant, as in the last year, we tended to go sideways. So there seems to be something else that's also supporting the Sui price that's not just raw usage of the blockchain. This becomes especially clear once we look at Sui's dominance within all of crypto. So when we look at all of the market cap across all blockchains, across all crypto assets, and we look at the market cap of Sui in relation to all of crypto, then we see an interesting turnaround. One might expect that once the usage of decentralized finance goes down, that also the Sui dominance should go down. So let's have a look at Sui dominance starting from the beginning of September of last year. That's this data point over here. The Sui dominance actually went up. So Sui outperformed the rest of crypto by more than 200%, despite decentralized finance having rather shrunk since then. So what's going on here? Why did Sui suddenly perform that much better? We are going to discuss this in a second, but by the way, if it's your very first time here, feel free to subscribe. I publish videos on Sui regularly on this channel over here. Let's see whether or not Sui currently is cheap or expensive relative to other layer 1 blockchains. So Sui currently has a market cap of close to 13 billion. Let's compare this with Hyperliquid that has 14 billion of market cap and Avalanche that has 12 billion of market cap. How does the usage or the TVL on the blockchain compare? So again, Sui has a total value locked of 2 billion. Hyperliquid has 2.6 billion. Avalanche also has around 2 billion. So it seems like Sui is somewhat fairly priced. We could make the argument that maybe the growth trend for Sui isn't as constant compared to the growth trend of Hyperliquid, and that Hyperliquid should thus be more expensive, relatively speaking. But this is not a video about Hyperliquid, this is about Sui. What I think is supporting the Sui price is short-term perpetual futures trading. It's open interest on the price. A lot of people bet on Sui. Why do so many people bet on Sui? I'm not so sure. But there's a clear mismatch. Have a look at this. This is CoinGlass, and it measures how much perpetual futures trading or how many short-term bets are currently made on various cryptocurrencies. Sui is at place number 7 here with an open interest of 2 billion, which is close to the entire total value locked of the chain. For comparison, AVAX has only a total value locked of 1.3 billion. So SUI is at place number 7 in terms of open interest, but it's only at place number 14 in terms of market cap. So the open interest relative to the market cap is very high for SUI. Most people that bet with perpetual futures on SUI tend to bet on rising prices, as in there's a positive funding rate. The longs have to pay the shorts in order to get more price exposure. Now this is a problem because there is a positive correlation between the spot price and the amount of bets on the price. When there's more bets on the price, the spot price tends to be high. When there's less bets on the price, the spot price tends to follow as well. And currently we are historically on a high level in open interest. If open interest was to suddenly come down, it would bring the SUI price with it, unfortunately. And so there are two potential ways to interpret this chart, the SUI dominance chart. The first way is again that the potential risk to potential reward is somewhat balanced. That we might be on the lower end of the trading range that had been established 1.5 years ago. But the second explanation is that maybe we are looking at lower highs over time. That maybe the potential reward to the potential risk isn't that great. I tend to think that the second is rather the more likely scenario. Again, because we've got all of that short-term leverage, and we have seen hundreds of millions of dollars of deleveraging in the past, and that again depressed the spot price quite a bit. That was when SUI went from close to $5 all the way down to $2. I'm not saying that we will see the exact same scenario playing out again. I'm just saying that currently the risk in SUI is not necessarily that low. SUI has performed incredibly well versus Bitcoin, given that the token was that inflationary. But we have to see more growth of the ecosystem. We have to see DeFi platforms growing more and more. And platforms of perpetual futures like Bluefin are definitely one potential way to attract more growth. Hyperliquid is currently dominating the space, but Bluefin could potentially catch up as well. It currently does have positive momentum. Besides all the medium and short-term price movements, it's also always interesting to see what happens long-term. What kind of assets can we actually hold over the years? Because once we know that, we know what to do during times of potential sell-off. I think, for example, that there's no question that Bitcoin long-term will appreciate in US dollars. Have a look at the percent of Bitcoin supply that has not moved in the last 5 years. This fraction tends to increase long-term over time. So there's less and less Bitcoin that's available for active trading. At the same time, we see more and more Bitcoin getting purchased by the treasury companies. And we've got the ETFs on top of that. So one might argue that roughly 30% of Bitcoin supply is in the diamond hands, or it's completely lost. At least net, this chart is unlikely going to go down significantly. We've got more than 5% in the hands of the treasury companies, and we've got roughly 7% of the supply held by the ETFs. So that means more than 40% of Bitcoin supply is in the hands of entities that tend to just stack away their Bitcoin over time. All of those curves tend to go up over time. They tend to not go down. And again, this reduces supply. This increases the value. Yes, there is Bitcoin mining of 0.83% per annum, but that mining is much slower compared to the rate of lost Bitcoin or of accumulated Bitcoin through the treasury companies or through the ETFs. And so this is where crypto and especially Bitcoin differentiates itself from other asset classes. For many other asset classes, we see as prices go up that it's mainly the short-term investor that wants to make a quick buck. But we can see with the Bitcoin rally from recently 16K to above 100K that it's the long-term holders that tend to just accumulate over time that are causing the rally. So that's what we want, right? We want that the people that buy an asset, they're not selling it anymore in the future, at least in aggregate. And this is, I believe, what we see with Bitcoin. And so I don't think it's a real question whether or not Bitcoin will appreciate in the future, especially versus the US dollar, because the US dollar has an expanding supply. It tends to grow by roughly 6.8% per annum. So this is USM2. This is official numbers by the Federal Reserve. If we look at the money supply in 1959 and compare this with the money supply today, within 60 years, the monetary base expanded by 77x, which is an annual growth of 6.8%, which, by the way, is the majority of the return of the stock market as well. Most of the stock market return is just monetary debasement. And so when Bitcoin becomes more and more rare over time because of those entities, and the fiat base grows more and more, then the most straightforward approach would be to simply use the same kind of investment tactics that we have for other asset classes, right? For the stock market, for example, we've got our savings plans, our 401ks, or for property, we've got our mortgage payments, where again, we pay in regularly with our cash flow. We can do the same for Bitcoin. For Bitcoin, it's typically called dollar cost averaging. So for example, if we buy $1,000 worth of BTC, and we do this for the long term, as we do with property and as we do with the stock market as well. If we just expand our time horizon to say 6 years, so beyond a cycle typically for Bitcoin, then it's extremely likely that over time we are outperforming classical investment approaches, because again, Bitcoin becomes more rare over time and it still gets more and more adoption. Had you followed this $1,000 per month approach with the S&P 500 or with gold, and you did this for 6 years, you'd be at somewhere around 120, 130K now. Had you done the same for Bitcoin, you'd now be at 360K. So roughly 3x the amount. And so this is where Bitcoin differentiates itself massively from the altcoin market. With the altcoins, we do not know what will be around still in 6 years, what will still be relevant in 6 years. The altcoins are highly inflationary, as in projects issue new tokens over time so that venture capitalists can sell their tokens, so that the team can sell their tokens. There are vesting unlocks. And when we look at the entire market, the entire altcoin market that's tracked here on Tokenomics AI, we've got unlocks of roughly 1 billion per week. So as long as we don't see 1 billion of purchases every single week in the altcoins, the prices of the altcoins are going down. Now, how much is 1 billion per week? Let's compare this with Bitcoin. Bitcoin has a market cap of 2.27 trillion and it's got an inflation rate of 0.83%, which by the way is debatable because again, we've got the purchases by all of those other entities and we've got the Bitcoin that gets lost. But let's ignore all of this. Let's just say this doesn't exist. Let's say we really have a net issuance of those 0.83% on the 2.27 trillion. If we run the numbers, we've got selling pressure of 371 million per week. So roughly a third of what the altcoins have as selling pressure. Now, how likely is it that the altcoins in aggregate get purchased at 3 times the rate of Bitcoin when Bitcoin already has this direct link to Wall Street? I think the likelihood is rather low. On top of that, the Bitcoin market cap is roughly 7 times the market cap of the altcoins. So the selling pressure is only 1/3. The market cap is 7 times as large. So really, relatively speaking, the altcoins have an inflation rate that's 20 times larger. And that's what's causing this situation. This is the smaller altcoins, the performance in the last year. Bitcoin has roughly doubled in the last year. And just have a look at how many altcoins that are shown here have doubled. There's 1, 2, 3 altcoins that did roughly the same as Bitcoin. There's only one outperformer. The rest all massively underperformed. And this is not a coincidence. This is simply just capital concentration towards the long-term winner in the market. You can't buy Quick or Myro or Pika or Atlas for $1,000 every month and just use this as another savings vehicle. Dollar cost averaging into those assets doesn't make sense, but dollar cost averaging into Bitcoin or Ethereum very much makes sense. And so I'm taking advantage of this capital concentration process. I'm betting on most altcoins doing worse than Bitcoin over time. And that's how I create additional alpha over just buying and holding Bitcoin. I don't just dollar cost average into Bitcoin, I dollar cost average into my trading portfolio, and I buy Bitcoin and Ethereum and Solana, and I sell or short sell all the bad altcoins over time. So this is my active trading portfolio measured in BTC. And of course, there is a lot of dollar cost averaging happening here as well. There's additional capital that enters this portfolio every month. But had I not dollar cost averaged at all, then because of my relative valuation trades, I still doubled the money. So without the relative valuation trades, my portfolio would now be only at around 2.5 Bitcoin instead of 5 Bitcoin. That's the kind of impact that's doable after 4 years of following such a strategy. So basically take this DCA approach and just 2x that capital. That's then 720K versus just having around 100K doing a traditional S&P 500 savings plan. Have a look at Arbitrum, for example. This is the number of ARB tokens over time that are circulating. When the supply expands and the demand doesn't expand at the same rate, then the price underperforms. Now, this is Arbitrum in US dollars, and this already doesn't look that great, right? We have seen Arbitrum going down by 60%. But compare Arbitrum relative to Bitcoin, it's much, much worse. Again, because Bitcoin has all of those inflows from traditional finance, and because a lot of Bitcoin gets lost over time, and because Bitcoin does not have this ultra aggressive supply schedule. The number of Arbitrum tokens is expanding faster even than the number of US dollars. And that's why it's losing even against the US dollar, but it's definitely losing against Bitcoin. And so my approach to generate alpha out of this is to just flip this chart around. So instead of looking at ARB relative to Bitcoin, here's Bitcoin relative to ARB. So you're going short Arbitrum, we're betting on falling prices of Arbitrum, we're betting on rising prices of Bitcoin. And what we see in orange, this is just the Bitcoin price during the same time. So we outperform buying and holding Bitcoin massively with that strategy. For example, over here, since the beginning of 2024 to today, Bitcoin has appreciated by 164%, but Bitcoin relative to Arbitrum has appreciated by 678%. Now, this is way higher than the alpha that I personally achieve, but of course, I'm also rather risk averse. I don't bet the entire portfolio on a single token, and not everything that inflates as aggressively tends to also lose that constantly. But again, it's all about the long term. It's about building wealth over several years, not just speculating on what's happening next week. Now, granted, betting on relative valuations, so something going up while the other thing is going down at the same time, is a bit more complex compared to just buying an altcoin straight out. But that's why I made dedicated videos on the topic. There's actually only 2 videos that you have to watch. So there is this one over here, using perpetual futures to bet on relative valuations. And there's this one over here, risk management with relative valuation bets. It's 1 hour in total worth of content. And after you've watched that, you know how to set up positions like this. Now, there are bets that are a bit more risky than others. Arbitrum is rather risky. Just have a look at this drawdown here. But there are also more constant winners. For example, have a look at this. This is Bitcoin relative to Balancer. Balancer, again, being a very inflationary token. Here's my offer. You watch those 2 videos, you learn how to set up those relative valuation trades and how to do the risk management properly. And then afterwards, after you've joined the community, I will send you my favorite trade. So I've got several of those relative valuation trades open, but I will send you my favorite one. And if you don't make money with that favorite trade after 1 month of holding that relative valuation trade, then I will just refund you the membership fee. So this video over here and this video over here. And if you don't make money with that favorite trade, you will get the $125 back. That's the fee per month. I, of course, share every single trade that I make. I don't just share my favorite trade. I share all the trades that I make in real time to the premium members. A link to premium should pop up directly here on the screen. Just click on that. It will lead you to the website. If it's the very first time here, feel free to subscribe. I publish this regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time on YouTube, or see you in premium. Cheers.